Compound Nation. Everybody in the chat's talking about Top Gun. What is going on? Aerial stunts are stunning. Thomas Carba, I agree.
Did you like it?
Oh my God. I'm going back. I'm going again. I'm definitely going again. Are you going to go twice?
It's the only movie I've thought in a long time I thought about going back for IMAX. I didn't see an IMAX.
I didn't see it in IMAX. I saw it in the United Artists version of that.
Farmingdale?
It's called RPX. Lynbrook. Almost couldn't find a parking spot. Lynbrook's a pain in the ass. It doesn't matter. I went with four people.
How good was that movie?
We had so much fun, and the theater. We sat in the back row with like the chairs that turn into beds. The theater was rumbling under us. Like I can't even describe.
It was loud. Yeah, so
like
good.
Every time somebody like fired up a jet, you really felt like you were in the jet.
Yeah,
it was so good. It was sick. All right, so Top Gun was good. Cliff Peebles, Jay Luther, Nicole's here. She's asking are there Stranger Things fans. We'll get to that. Tom Schott, Warren Z, Sam Chisholm. We love you guys. Thanks for coming to the live. We have a lot to do tonight, so I'm going to cut short the hellos. But first, we want to mention our awesome sponsor, FTX. Michael, say some things about FTX.
Oh, I'll say some things, but first, I'm very disappointed that we're not going to see the FTX arena. The Celtics. Listen, they were the better team.
I bet you Golden State would have rather have seen the FTX arena than Boston. I'll tell you that much.
FTX should buy the TD Garden. Is that for sale? Anyway, what can you do now?
Does that become Schwab? The TD Garden? How does that work?
Ooh, that's a good question.
Like if you have the sponsorship rights to a stadium and get acquired, does it automatically change over? Can you picture people from New England trying to pronounce Charles Schwab? What would they even say? Charles? No, like Charles.
I don't know how they say Charles.
Charles Schwab.
Anyway, at FTX, what can you trade? Crypto, NFTs, stocks, all in one app.
Not bad. Is that where you trade?
No, I'm in New York. Can't do it in New York.
Oh, you can't do that in New York? Why?
Unfortunately, I'm stuck on Robinhood. I got no out. I got to get out.
When FTX goes live in New York and you're able to use it, you'll be all over it?
I got to get my crypto off Robinhood. It's a whole other story.
Yeah, I don't think you can get out. I think you can only get in. All right, let's talk about what I think is among the biggest stories of the week. I'm not sure it's the biggest because it just felt like we were in a 6-day weekend. But inflation is still the thing, and hang on one sec.
Wait, me first.
Yeah, you're first. We're gonna do that later. Go ahead.
What? We're doing what later? What the hell just happened?
No. Go ahead. You're up.
All right. Okay. So right now we're in the bounce zone. We're in the highway to the bounce zone. Who knows how high it goes? If this is the beginning of the beginning or beginning, who knows? But Nick Majuli did a few charts, showing how painful bear market rallies can be. We're gonna go through this quickly. The one from the Great Depression, I feel like this is the absolute hell zone. And I think that this type of market is a thing of the past. I really do. I just think that, listen, this was the Great Depression.
Wait, Mike, I'm sorry, but let's set this up a little bit better. Last week was an amazing week for the S&P 500 in that it shattered a 7-week losing streak. And we were up 6.5% on the S&P.
Best week since November 2020?
Yes, and I think the point of Nick's post was like...
Was that it?
Well, 7 weeks down straight, something should happen to the upside. But the history of these types of things, once you're in a bear market, should maybe give you a little bit of hesitancy to get too excited. Okay.
Agreed. Counterpoint. Agreed, but counterpoint is that these big bottoms have been the bottom for every single bottom that we've seen over the last decade.
What makes something a big bottom?
A plus 6% week.
Okay. So like not just like they stopped going down, but wow, big reversal. Right. You're saying.
But what we can't know is is this a bear market rally, right? Which it easily could be. We'll see. By definition, rallies fail in bear markets. So you've got the one from the Great Depression. I don't even want to spend too much time on this because this is a different time, but this is just a nightmare.
Brutal.
Let's keep going. Yeah, let's just keep going.
Why is that so brutal though? Just like because like you feel like all right, it's over.
Well, because if you get cut in half in 3 months' time, I don't know what the numbers are here exactly, and then you get half of it back in the 48% bounce, you're like, oh, whew, that was scary, but it's over. And then it's like, no, actually, it's not over. And then it's just one after the other, and it's just demoralizing. Next. So by definition, you see rallies in bear markets, right? And they all fail, of course.
1973 to 1974. So this had 3 separate double-digit rallies while it continued to make lower lows. Look at that. Look at how much of the damage happened in the last 3 months of that one, too. Look at that.
You could see the psychology of buyers and sellers here, right? That's just brutal. Keep the charts on. No faces, just charts. Next chart. This is a nasty one.
Well, so this was my first experience in the market. Like I started as a cold caller in the late 90s, and then by the time I was like actually talking to clients, it was doing this shit. And I distinctly remember probably 3 out of these 6 like these specific rallies off the lows. And let me tell you about just one of them. This thing where in the fall of 2001, after the technology market got hammered, then all of a sudden like 9/11 happens, and it just accelerates. Go back, chart back on, and then it just like accelerates the fall, and then we have this huge bounce into January of 2002. And in January of 2002, there was a lot of optimism because we came all the way back from 9/11, and everyone was waving American flags, and there was this feeling that like the whole economy was going to be okay. It was just the dot-com stocks, and that was over. And then like Enron happened, and WorldCom, and these massive corporate frauds. They put Arthur Andersen out of business. It was the biggest accounting firm in America. They literally ended it because they were involved with Enron. So that was an example of another trapdoor where you had a 30% rally off the bottom and it still wasn't good enough.
No, it's kind of
rolled right back over.
By the third green dot, the plus 20, you really weren't down that much from the high. You probably thought, okay,
it wasn't bad.
You probably thought, okay, we survived, not bad. And then once you get that post 9/11 bounce, you're like, okay, it's been 2 years, right? We had a 2-year bear market, and we're gonna take out the highs. Nope. The last 2 were especially. You could just feel it. Just looking at it, were especially.
You know what happened though? It was very similar to this. Like all of a sudden, Buffett was back on top by 2002. Like they were writing positive articles about him again because Berkshire had no exposure to dot-coms. Very similar to now, and he was making all these housing-related investments as the Fed was cutting rates, eventually down extremely low. I think they got down to 1% or something, and which used to be what we consider low. And it was a very similar situation where value came back and growth was hammered. It almost was like mirror image to today. And I'll really never forget though those last couple of sell-offs. People were just like, you know what? I'm done. I'm never doing stocks ever again. That's really how a bear market has to end.
And let's go to the most recent one, 07 to 09. I feel like this one, nobody trusted that 18% bounce.
Look how it took place in like a week. It was bullshit. You know what happened? You know what really happened? It was like, okay, the economy's getting worse, housing's getting worse, blah, blah, blah. And then Lehman.
Right.
And then like AIG. And then Goldman needed to be bailed out. And then at the end, Madoff. So this is where that last 20% ended. Madoff was December, or right after Thanksgiving, or right before Christmas. So it was just like, and then you could see how much damage was done in the first 3 months of the year.
You know where I was
into the bottom
when I learned about that? Chart off. I was in Bagel Plaza. I remember seeing the cover of Newsday, and I was like, wait, what is this?
Wait, who was on the cover of Newsday? Bernie Madoff?
Yeah.
People don't understand.
I didn't know who he was. I was a kid. I mean, obviously, I didn't know who he was.
People like, well, what does that have to do with the bear market? That's like the moment where every East Coast wealthy person,
it was salt in the wound.
Florida or New York or New Jersey, was like, I don't trust fucking anybody. Like, I don't care where you tell me my money is. Literally give it back to me right now. That was that moment. And it had nothing to do with the economy. And it had nothing to do with the stock market, really, because he wasn't even trading. It's not like they had to unwind Madoff. There were no trades. So that was pure, like, a punch in the face from sentiment at that point.
So, okay.
I remember it.
So the month of May ended today. The S&P is now in a 13.5% drawdown. It got as low as about 19%. By the way, what's with these 19% rallies just effing with us? These 90%.
This is an algorithm that buys down 20.
Okay, so May was flat. Despite all the choppiness, May was flat. We had that 6.5% rally last week. So I was thinking, as one does when you get another big bounce, like, what if we get new highs in the fall or the winter? Which, by the way, I am definitely not in that camp. I would be quite surprised if we get new all-time highs in the S&P 500 later this year. Would I be shocked? No, of course not. I would be surprised.
We'll have a better chance of seeing Disney greenlight Pirates of the Caribbean 12.
No, stop.
With Johnny Depp.
It's not that far. It's 13%. Could happen. Much crazier things have happened. I don't think it's happening either.
New highs.
I don't think it's going to happen either.
Think about what you need, though. Think about what you need the fangs to do. Why would that happen?
Well,
it's gonna happen.
That's what I want to talk about. What would I think the simplest narrative, the stories we're going to tell ourselves if that happens, is, you dumb bastards, you acted like going from 0% on the Fed funds rate to 1% was like sort of some sort of catastrophe.
You're gonna go like we're gonna be like 300 Dow points away, and you're just gonna be like, there's the V is back, right? I think I will be most shocked just because the amount of support the Fed is removing from the market, like in real life, not what they're talking, but they're actually 2 days from now, they're done buying bonds. Think about that.
I'm telling you right now, if we V, I'm fighting it the whole way up. I'm just going to be kicking and screaming.
I'm going to be making money and super grouchy.
What will the narrative be if we start to rip like hard and like approach new highs? What will it be?
Tina, they're going to say...
We overreacted. That's all it could be. We overreacted.
They're going to say, what are you going to do? Buy Europe? LOL. This is the only game in town. Rates are still low historically, blah, blah, blah. You know what they're going to say. I'll say it. I'll say that shit. I don't care. All right. Barron's.
Get ready, just in case.
Barron's did a really great cover story on Bitcoin for their octogenarian audience. No, I'm just kidding. Darren Fonda wrote the cover story. I thought he did a great job. And I was surprised. I thought Barron's would probably grave dance on crypto. And reading the commenters, I guess if you're...
why would they grave dance? It was like an interview style thing. They had crypto people in.
Well, no, I didn't know what it was going to be. Okay. I didn't know. But yeah, I'll get to that in a second. I figured the next time Barron's does a Bitcoin cover, it's going to be like a cemetery.
Right.
And let's say every tombstone will be the symbol for a different crypto.
Like the Facebook,
they didn't do that.
Like the Facebook $15 thing.
Now, if you read the story online, which I think most people do these days, and not in the app and not in the actual physical, you can see the comments below the article. And, the Barron's audience is not really a crypto audience, but there's so much skepticism, and a lot of people are in there like, oh, Barron's just wants younger readers. And that's like, it's like guys my dad's generation, like, oh, look at this shit, shilling for crypto. They just want young people to care about Barron's, whatever. I didn't take it that way. I thought it was really well done. I'm just saying repeating what the commenter said. They had 4 people, and this is what they're calling their new digital asset roundtable or something. Like they never had. Here, what do they call it? Here. We asked the panel of industry experts to weigh in at our first ever crypto roundtable. Dan Moorhead, founder and CEO of Pantera Capital. He comes off as the most crypto-y of all the people mentioned in here. Obviously bullish. That makes sense. Alkesh Shah, head of digital asset strategy at Bank of America. Lisa Shallett, who's the CIO at Morgan Stanley Wealth Management. That was a surprise. And then they had an economist at Cornell University, Eswar Prasad, who has a new book, The Future of Money. So it was a spectrum of extremely bullish to sort of bullish. They really didn't have skeptics. And I paired this article. By the way, do we have the cover? Can we throw that up?
I don't know if we told him to grab it. Did we?
Maybe. I don't know. Maybe not. Doesn't matter. All right. I paired this article with the most skeptical take I've ever read on crypto. This interview with Nicholas Weaver. Did you read this yet?
No, I didn't.
Current affairs. This is this. Oh my God. This is like the most pitch black take on crypto. And I wanted to ask you, at a certain point, do you have to pick a side? I know you're supposed to read both sides and you're supposed to like understand the bullish and the bearish case. I think with something like this that's so controversial, you almost can't do that because you'll end up with no opinion. I read these two things back to back. I'm reading about the CIO of wealth management for Morgan Stanley. What do they have in wealth management assets? $2 trillion?
Trillions, yeah.
Right. As bullish, and then reading this, which let me give you a little tiny taste. I'm a savvy investor, and by savvy, I mean I put my money into index funds. He's talking about the difference between Bitcoin and the stock market, or crypto and the stock market. During that time, there were dividends and share buybacks where the companies put their profits into me. I then eventually sell it to someone else, and my gain is not just the difference between what I bought it for and what somebody else bought it for, but that plus the benefit of all the dividends and interests. So the stock and bond market are positive sum game. There are more winners than losers. Crypto starts out zero sum. It starts with a world where there can be no winning. There could be no more winning than losing. We have systems like this. It's called the horse track, casino.
Not true.
Crypto investing is really provably gambling in an economic sense.
Not true.
And then there's designs where those power bills have to get paid somewhere. So instead of zero sum, it actually becomes deeply negative sum. It's tough to read these two things back to back and like have your head straight. I don't know. What are your thoughts?
So obviously, there's a ton of disgusting frauds and scams and bullshit in crypto. We know that, right? Nobody would argue that. But this idea that it's negative sum is just not true. For example, with Ethereum, 30% of the fees paid to the network go to the miners, and 70% goes to burn ETH, which is, it's not a stretch to say that's analogous to a share buyback. And then if you look at a lot of like the DeFi protocols, they're generating tons and tons and tons of revenue that go right back to the people that are staking the network.
He's saying it's
just not true.
It's a self-organized pyramid scheme, that feature of it. He's not saying it's not, people aren't making money.
He's saying it's
only making money by
negative
recruiting
sum.
people to come into it.
He's saying it's
after
negative
them.
sum.
I think he's saying it's negative sum because, like, by definition, there are people making lots of money, but those are the people who are in early and selling it to people who come in later. Forget about all the frauds and blah blah blah. He's basically here. Let me give you the Ethereum. Remember the whole code is law business. No central authorities. That's a lie because the developers of Ethereum have 10% in this self-assembled Ponzi scheme. So they updated the code. So he's talking about the theft and how they just changed the code to make it so the theft never happened. The reason I say it's rerunning half a millennium of failure is that at the start, there's a huge amount of tulip mania, blah, blah, blah. So he's basically saying, like, you have to understand that the insiders are making huge money, but that's only happening because people are coming in later and taking them out of their coins, taking them out of their tokens.
I don't think you have to be like an evangelist or an absolute psychopath saying burn it all down. It's all bullshit.
Yeah, but you kind of do.
Well, if you're gonna be published, you have to. You can't write something that's not provocative and get any sort of airspace. You can't be like, listen, it's a new technology. Yeah, there's a lot of bullshit, but there's a lot of cool things being built, and we'll see. Like, nobody wants to read that.
Well, what are the cool things being built? Like, can somebody share one with me that's not crypto related? Because that's one of his other points. Look, this guy's a computer scientist. Yeah, this guy's a computer scientist. He's like, here's the iron law of blockchain. Anybody who says that there's a problem that can be solved by blockchain is outing themselves as an idiot because there's not a single problem in this world where blockchain is the easiest solution. And he cites numerous examples of people giving TED talks.
All right, well, I could give a counterpoint. The guys at Audiograph that built our NFTs, and these are computer engineer people, like Python people, described the blockchain as magical. He said things that would have taken me weeks and months 5 years ago, I was able to build on the blockchain in 14 days.
Right, but could also be built with any other type of code also.
Listen, I can't speak to that. Who knows?
Right.
But anyway,
I'm not going to be the one. I'm not going to be the one.
If they're trying to rebuild part of the financial system, it is all financial stuff. So if you're looking for use cases that are outside the realm of transferring money, digital ownership, that's what it is. And yeah, it's dominated. All you see is the bullshit nonsense. And like you and I aren't privy to a lot of the actual stuff that people are building, so we're not seeing it on
when they try to take things in the real world and apply a blockchain solution. It often either makes it so people say, well, what do we need the blockchain for? It's just like extra bullshit you're bolting on, or it actually makes things worse. The example Weaver uses of El Salvador, I think, is important. He says, quote, the president of El Salvador is a totalitarian nutcase. One of the things he did as a totalitarian nutcase is pass a law saying Bitcoin is legal tender. But you aren't actually using Bitcoin. Instead, they created a new wallet, the Chivo wallet.
You lose me at all that shit, all that macroeconomic nonsense. I'm not here for that.
Well, he's basically saying the wallet doesn't actually do Bitcoin transfers anymore, and nobody uses it. Everybody signed up for the free $30, and now they're basically just running a cash business, and the wallets are empty, and nobody's downloading them. So it was like a massive, colossal, countrywide failure. It doesn't mean another country couldn't come along and try it, but you now don't hear anything from the blockchain people about El Salvador because it's ridiculous. So that it's like an example of like, yes, there's good intentions. You have unbanked people. It's of course everybody would like for there to be a solution, and if it's blockchain, great. It just isn't though, because it's too hard to use. You can't do enough transactions on the existing networks. It's too expensive.
I think digital currencies and stable coins are going to be huge, but obviously open to the idea that they're not going to be. I don't think anything's inevitable.
What if they just turn out to be good things to invest in, and they never have any real world use, and people stop even caring that they don't have any use? Isn't that a third way where everybody can claim they're right? So the skeptics could be like, you see, this is all just trading bullshit. And then the bulls could be like, yeah, but who cares? I got in 2022, and look how much my portfolio is worth 5 years later. Like, that is a way that this could go. It seems to have gone this way all this time. So I don't know. I thought these were two interesting things to read back to back.
When did crypto start to become mainstream? 2021?
17.
I don't think so.
Yeah.
That was a flash in the pan. That was so quick.
No. That's when everybody first heard of.
That was a moment in time, and then it crashed 90%.
Okay, it's not mainstream now. Then, by that definition, it's not mainstream now. They say 12% of U.S. adults have used crypto, but they haven't used it.
And so anything. This is like the we're so early people, which is fair. It still is so early.
Could definitely be. Could definitely be. The one thing from the Barron's piece that I thought was interesting is all four of them agree there are not going to be 50 blockchains. There are not going to be 50 layer ones. So some of them say there's going to be 3. Some of them say there's probably going to be 5. None of them think that most of the existing layer 1 protocols are going to survive, which I think is rational.
I am a believer in Bitcoin. I buy it when it crashes, but I never bought into there are only 21 million Bitcoin. Few understand this. Inflation, fiat, blah, blah. All that to me was all bullshit all the time.
This guy Shaw is saying what's attractive about Ethereum is the actual cash flows. Last year, $10 billion of fees were paid to network operators for processing transactions on the Ethereum blockchain.
And how much was burned?
So So he's saying there's cash flow here, even if we don't yet have a model for figuring out the intrinsic value. With Ethereum, 70% of transaction fees
that's what I said. I literally said
will be used to burn tokens, kind of like a share buyback. 30% will go to stakers, people who own the tokens and use them to help secure the network.
I literally said that. I think it's a fair equivalent.
Right. So we don't exactly
know. How is that negative sum? How is that negative sum?
I think He's
That's
talking
enough,
about
that's
the
enough.
whole ecosystem.
All right, whatever.
So,
Maybe.
go read it. Tell me what you think. We'll discuss another
No,
time.
I already made up my mind.
Oh,
Okay. All right. We're gonna talk about. Oh no, it's your turn. Is it my? No, it's my turn. Sorry.
It's you.
All right. Let's talk about value spreads. So this comes from Cliff Asness and his colleagues at AQR. I want to first show the tech sector. So this is interesting. People debating like, no, it's worse than the dot-com bubble. No, it's not. Well, according to this, it's not really that close. What we're showing is the expensiveness of tech versus the S&P 500 is 84th percentile. So listen, obviously, it got shit got crazy, but not like 2000 crazy.
Yeah. Oh wow. Look at that in '99. What is that?
Qualcomm,
does that mean that the IT
Cisco.
sector was 5 standard deviations relative to the S&P value than where it normally is?
Yes.
Is that so? The zero line is when there's an equilibrium, or at least a historical ratio.
And
All
I
right,
think
so
this,
we almost got there, but not quite.
I think this is a long short basket. But what's more interesting, said twice for emphasis, is the next chart. Now, what this is doing, it's level setting the industries and the companies. So we're like equal weighting everything. And it's showing that growth, again, within industry versus value stocks got more extreme than the dot-com bubble. So the point is that Cliff was making is that stop saying it's all tech. It's not all tech. It's everything. Everything growth versus everything value got more expensive in 2021 versus the dot-com bubble.
I think I know what you mean. Like, so for example, apparel stocks, whatever the cheapest company was in the apparel space.
Right. So if Dick's growth and Foot Locker's value, for example,
I think probably the top decile of expensive apparel stocks would be like Lulu.
Yeah.
And then like the bottom decile would be like Ross Stores or some shit like that.
Yeah.
And all right, so it was a phenomenon where people, no matter what industry, obviously tech included, were looking to grow their money like crazy, relative to all other concerns.
And I think the explanation for this is fairly simple. We were in a low interest rate world or a zero interest rate world.
We were in a bubble.
And a low growth world where growth just was hard to come by and you'll pay whatever.
That's right. That's exactly right. If you're in a low growth environment, the companies that actually have growth and are not reliant on the economy for
Can't
that
pay
growth,
too much. Can't possibly pay too much.
either because they're creating a new category like in tech, or they're taking tons of market share like in a lot of value industries, sectors. People were prioritizing that in their tilting. And the stocks had momentum and et cetera, et cetera. I'm
So
working on that.
I didn't read this piece on Cathie Wood yet. Did you?
Well, so this is the other side of that. You don't have to read it. What I thought was interesting about this is not a financial publication. Intelligencer is New York Magazine. And this is written by a reporter who is not a finance reporter, is not a markets reporter. This isn't about her alpha versus a benchmark, but this is like mainstream now. And here, around the middle of April, Cathie Wood sat on stage at the storied Fontainebleau Hotel in Miami. That's our friends Matt and John, their conference for Advisor Circle, right? That's Exchange?
Exchange.
Yeah. Okay. It was an awkward time to be a keynote speaker at a conference for money managers. Wood's flagship fund had lost roughly half its value over the prior year. Blah, 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 blah. So basically, like a year earlier, she thought her firm would deliver annualized returns of 15%. Turned out to be more like negative 35%. And then she doubled down. She said, now we think 50%. And, of course, that didn't happen either. So basically, I was thinking about this as like, and I know we were talking about 2000 to 2003 before. The ARC story is a mirror image of the Munder Net story from 20 years ago. There was no social media. And Paul Cook, who was like the guru running the Munder Net fund from 1996 to 2002 or whatever, he didn't have the charisma that Cathie Wood had. Like, they didn't like make him a brand. And he wasn't on TV a lot. But a very similar thing. Here's the big difference. In March of 2000, 3 of the biggest internet funds, mutual funds, closed. They said, we're not taking any new money. And Munder was one of them. They got to $11 billion. They raised like $9 billion in the previous 3 years, and they got to 11, and they said, that's it, we're done. There's another fund called Amarindo. They did the same thing. And I think Merrill Lynch had their own internal internet stock fund. They closed it too. In my opinion, that probably limited the losses by about half. In other words, if they had kept taking money in throughout the year 2000 as the dot-com bubble slowly and then rapidly deflated, a lot more money would have been lost. ARK can't do that. It's an ETF. It's exchange traded. They cannot halt creations, I don't think, without like having a serious problem. And if you're a manager and you see way too much hot money coming in, the worst thing that you could do is goad it on. Like, you know it's going to hurt your future returns if you get to $50 billion for one strategy. You have to know that. But the problem with active ETFs versus active mutual funds is that what Munder was able, and it was still a debacle, by the way. They got cut in half that year, cut in half the next year, and then eventually wound it down. But at least they were able to stop the money. I don't think that ARK was able to.
I think that they have burned, I think ARKK has burned $15 billion of investor money on, not on fire, but you know what I mean. I think $15 billion is gone.
But it's, and they still have $16 billion under management as of the publication of this article, which I think is one of the main points that they're making.
I do want to say though, John, throw up this chart. We do have what I've been looking for. You see that, Josh?
You got a higher low?
You got a higher low. Now, if I was
a very different portfolio than it was on the way down.
If I was a betting man, and I'm not, but if I was, I would.
Do it.
You could buy here and limit the losses to those whatever those lows are. What's that, like 5% below, 8% below?
Are the short sellers gonna stick with this on the short side if there's like a 20% rebound for ARKK? Like, what do they do in that situation?
I don't know why I don't know if you're short. I don't know if people are short ARK. It's a good question.
Oh, you have no idea how much money is short this thing. It's huge.
Why wouldn't you just short her companies or buy SARK?
Because they're short the strategy. They don't believe in it. It's not just that they don't believe in the overvalued stocks. They don't think that she knows what she's doing. They're short the portfolio construction. They're short the whole concept of buying the largest, most controversial, broken growth stocks in the market. Like, they hate the basket as much as they hate the companies individually. Here, this is a quote from a short seller, somebody who says, quote, she is part of the problem. They're short ARKK, quote, why wouldn't you be? She invests in every shitco going. Investors who bought Wood's fund at its peak last year, from which it is down 75%, would have lost much less money if they bought Bitcoin instead. She is the opposite of a short seller. She's a capital depleter. The amount of capital she's evaporated in the world, how can people even suggest she's successful? She's successful at failing. Like, this is very pitch black.
Yeah.
This take.
So SARK launched in November.
Yeah.
With like less than $5 million.
How much is in that now?
400.
400 what?
Million.
That's it?
That's it. It launched less than 6 months ago.
I know, but wasn't it like one of the most successful funds over the last 6 months?
Oh, it's got to be.
I can't believe there's not $1 billion in that yet.
I mean, it's up 100. It's up 100% since it started.
So I'm not a fan of this, but I do like what he's done since. This guy Tuttle, he launched a 2X.
What was that? TARK?
Positive.
Is it TARK?
So now you can bet on a rebound too. You could bet both. You could bet both ways. So now there's a 2X ARK and a 1X short. There might be a 2X short.
TARK started like a month ago with $2 million. It's got 20 already.
Right. Maybe that's the trade. I don't know. This is now crossed over in the way that I know I've used this analogy before, in the way that Meredith Whitney crossed over. Like, she was on 60 Minutes I think she might have had a cameo on 2.5 Men. I don't know. Like, she became like part of pop culture for having called the crash. What she really did was like write a negative report on Citigroup right before they did a big earnings restatement. But this hype and then hate cycle seems to be going exactly the way that did.
I think that unfortunately a lot of this was brought on herself. I really do, because when we were talking about this at the time, and I think we called it this is unserious when she said that her bear case for Tesla is $2 trillion, right? That was not even in the realm of serious investing. Her bear case.
She said that Tesla would go up 1,000%, and it did. Don't forget, it did.
Okay, so what? I don't forget that.
Okay, so she said Tesla. Everybody ridiculed her. Think about the smartest people we know of in the market were all short Tesla. They hated it. They hated Elon Musk. They hated the cars, the manufacturing. They hated the technology itself.
Okay, Tesla delivered. And then she said her bear case for Tesla is $2 trillion.
I'm just fine. I'm not saying that was like a reasonable thing to say, but when she said Tesla's going to go up 1,000%, everyone looked at that and said, that sounds bullshitty too. And then literally it happened.
Okay.
So it muddies the water a little. It makes it less cut and dry.
Well, not really, because I think that after you have, credit to her, 2021, all 6 of her funds gained 100%.
Yeah.
Amazing. But then to say that we're going to do 40 to 50% a year for the next 5 years is not serious. It's just not serious. It's not even close to serious.
I don't even think you're allowed to say that, like what you think your returns are going to be. Like, I don't think anyone's allowed to say that.
All right,
it's a whole other conversation.
Let's pivot.
Okay. Who's up? Am I? Oh, yeah. SPACruptcies. This was the easiest thing in the world to have seen coming. I feel like, I really do. I really do. Just because, not because of how horrible the SPAC structure is, which we talked about on this show ad nauseum for 2 years. Yeah. I think we told everybody that they needed to know everything they needed to know on this, but also just because anytime you have so many versions of something, it's automatically impossible to make money. Like anytime something gets this crowded. So let's assume there's like 10 great private companies for a SPAC to bring public. If you have 250 SPACs chasing them, how could that be good? How could that work for most investors? Of course it cannot. Here, this is, what do we have? We have the SPAC ETF chart. Throw this shit up. This is SPAC and new issue ETF. So this includes real IPOs in here too, which are helping. If this were pure SPACs, it would be way worse. At least 25 companies that merged with special purpose acquisition companies between 2020 and 2021 have issued so-called going concern warnings in recent months. This is from Audit Analytics.
Is that bad?
Yeah. Going concern means we might not make it as a company. The companies with warnings amount to more than 10% of the 232 companies that listed through SPACs in that period. That percentage is roughly double that for companies that listed through more traditional initial public offerings. Let's run through some of these.
But we can't get a spot Bitcoin ETF.
I mean, right. So Lucid. This is one of the names that that was one of the most popular SPACs in 2021. Clover, down 83%. This was a weird one. This was like a Chamath SPAC that merged with a healthcare company that had a hidden scandal that a short seller unearthed and just kind of made holding this thing unacceptable.
Remember SoFi? What was that? IPOE or F? I can't remember which one that was.
Yeah, that was one of the
IPOD?
highest profile.
Whatever.
Put up Pershing Square, Tontine, another complete...
Remember this convoluted nonsense, whatever he was trying to do?
Complete calamity. No, I think he really thought he was going to buy Square. And then he couldn't, so he tried to he turn it into a closed-end fund.
Or the music, Universal he was trying to buy?
Well, no, so that was after. He was like, all right, I'll buy a piece of Universal Music Group. And then the regulators were like, that's not what a SPAC is, dude.
Here's a SPAC.
It's not a fund.
Shares of SPACs that were listed in 2021 were down an average of 60% as of Tuesday.
Can you imagine? And people were saying like, oh, this is going to replace the IPO. It turns out the IPO is pretty efficient.
No, because IPOs handcuff you. You can't say whatever you want.
This is the problem. But I'm saying like the way that they arrive at pricing doesn't mean the price is right. Obviously, there's a huge up or down move the day of the IPO. But the way that they arrive there is a little bit more democratic.
So here's the problem.
A little bit less bullshitty.
The problem with traditional IPOs is the pop goes to the insiders and or the investment bank's clients, right? So we have to flatten that out. We have to democratize the IPO process so that retail investors can lose 60% of their money.
I mean,
that's what we have to do. Mission
and
accomplished.
the successful ones, the sponsors end up with 20% of the company. So you're actually paying them fees to become the majority shareholder of something in an example where one of these actually works. So even in a good outcome is still a bad outcome for shareholders because you forked over a fifth of the company to the sponsor. It was like a once in a lifetime, I shouldn't say that. Cash grab, wealth transfer from sophisticated fund managers and visionaries and gurus and celebrities who some of them knew better, some of them didn't. Retail didn't know shit. There were like people doing like, I do a website all about SPACs. I'm like, why? Why do you want to herd more people into this wrapper? I don't know. It's hot right now. All right. Substack edition, Funding Blues. I threw this in here. I thought this was an interesting story. This is like a really good business, I think, Substack. Like it's a good publishing business, but this is an example of a company that just waited too long. And this is, I think, what the new market reality is going to look like.
So this is why new highs are very hard to envision, because it just started. This investor confidence shift has only just started. So Substack, they're like, we did $9 million in revenue in 2021. Cool, right? Up from zero in 2019. Like it's not bad. But the problem is they were seeking $750 million valuation. You're not getting 75 times earnings. 75 times sales. I'm guessing there were no earnings. You're not getting 75 times sales anymore. That shit is over.
Yeah, I mean, and Substack has like a brand name. Think about how many startups that like have no revenue and nobody's ever heard of the product. Like, what is that conversation going to be like going forward versus what was it 6 months ago when people were begging to get into these deals?
So here's the thing.
Night and day.
How many of these companies were funded in 2021 that are never going to get another dollar? Because forget about how they're so underwater. It's like subprime. They're just all underwater. So I've said this a few times recently, but like there are now, I'm hearing from people that like hiring freezes, travel freezes, all of this stuff has not even begun to work its way through the system yet. Has not even started.
It's still pretty early. It's still pretty early, and a lot of the backers, the people that led funding rounds, are going to have to like go back into their toolkit and teach entrepreneurs about when and how to wind things down.
So you want to talk about negative sum, 100 times sales? That's negative sum.
Yeah. Well, it ain't going to happen now. So
and that relies on new money.
Yeah, I agree with you. I think it's probably the first or second inning. Even if the economy doesn't fall into recession, I feel like there's a psychological shift that will not get undone by a NASDAQ rally. In the private market. It
just started. Now, it would be funny. I was talking about this with Ben today. It would be very funny if the VCs are overcorrecting to the downside now and we get a 15% rally and they're like, all right, wait a minute. We're back. Hiring's back on. Let's roll.
V-shaped recovery in venture. Sure. Why not?
No. Okay. Why all right. Not? So sticking with this theme, and sorry, there's a heavy Cliff Asness show, but Cliff tweeted in 2019, he wrote a post in 2019 called the Illiquidity Discount. So there was an article in the Wall Street Journal, wealthy investors pile into private equity to escape stock volatility.
That's hilarious.
So Cliff wrote, I've been wrong about plenty of my life. On this, I am staggeringly obviously right. Institutions are stuffed to the gills with expensive equity specially designed not for alpha, but to allow them to pretend they don't own equities. He's 100% right. Chart off. So we used to talk about this idea of the illiquidity premium. Illiquidity is ostensibly a bad thing, right? You can't get your money when you want it, and therefore you should be paid a premium to give up that liquidity. actually, it's literally the exact opposite. So here's what Cliff wrote. Conventional wisdom, I just said this. Conventional wisdom is you get an expected return premium for bearing illiquidity. But what if this is backwards?
Meaning the investor who buys the asset that they can't get out of tomorrow will be paid more in exchange for that.
But why? It's because historically, illiquid shit traded at a discount to what you would get in liquid markets. Right? And that got totally inverted, to use a Top Gunism. So he said, what if investors will actually pay a higher price and accept a lower expected return for very, very illiquid assets? What if investors are simply smart enough to know that they can take on a lot more risk, true long-term risk, if it's simply not shoved in their face every day or multi-year period? And I think this is spot on. I personally would take lower returns in an illiquid investment vehicle, because getting marked to market every day sucks, as we're learning right now. It really sucks.
I don't remember the podcast I was listening to, but I'm 99% sure it was Cliff Asness telling a story about, I think, like, did he start an investment bank or something? Or
did he start an investment bank? Cliff?
No, start at one.
No, Goldman.
I think he was telling a story where everybody at the end of the day would say, like, how they did. And they would laugh because the guys running, like, the private funds would be like, I don't know, I think we're flat, this week, this month, whatever. So I think this is something that he's looked at for a long time. I happen to agree with him. And as a corollary, one other aspect of illiquid assets is because you're rarely moving them because they just can't really move, you do stick out a lot of volatility. And like the longer you're holding something, just like in the liquid equity market, the more opportunity there is for higher upside. This is why like the wealthiest families in America are all real estate families.
Yeah. Who wants to see their account balances fluctuate like that?
They don't sell, and even when they sell, they don't pay taxes. They do a 1035 exchange. They buy another asset. So it's a combination of holding the same asset for decades, and then when you do sell it, not being taxed on it. And that's why everybody with like crazy wealth, at least here on the East Coast,
they want illiquid shit.
They're real estate people, and they want to be illiquid.
So here's what I'm very bullish on. Places like iCapital. So their assets have risen 16% in the first 4 months of the year to $125 billion. iCapital is a platform for investment advisors, primarily to access alternative investments, private credit, real estate, hedge funds, whatever. So worldwide, this stat shocked me. Only about 1 to 2% of the estimated $80 trillion held by individual investors is allocated to alternative investments. John, throw this chart up. Look at pensions and endowments compared to individuals. I don't think that the gap is necessarily going to close, but that gray bar is going to get a lot higher.
Counterpoint. Who do we think whose money do we think it is sitting in pensions? It's individuals' money. They're just not managing it themselves.
Nah.
What do you mean, nah? Who is it for? The aliens? It's for individuals. They just don't have agency over it.
Endowments?
What's the end use of an endowment?
To fund goals and stuff.
An underprivileged person being able to get into a university. That's still eventually.
Wait, how is that? Hold on. How is that a counterpoint?
Because I think that people do have exposure to alternatives. They just don't know it because they're not deliberately taking that risk themselves.
The people that have pensions are not the same investors that are going to be allocating their own personal money to invest to alternatives.
Oh, here's the other reason why. The returns have not been good.
Fact.
The returns have not been good. The returns of alternatives are terrible.
You're talking about hedge funds.
Dude, the returns of most alternatives that retail investors have had access to are terrible.
True.
These 100% are facts.
True. 100% true.
Doesn't mean every hedge fund is bad.
100% true.
But individuals are not going to get into the good hedge funds. And if they do, it's an accident. And you know when a hedge fund's doing really well? When they start firing people as clients.
Fine. There are other illiquid investment vehicles other than hedge funds.
All right, let's keep it moving. Our time is running short. I was really excited for you and eventually me.
Thank you.
When I read shares in. By the way, I don't own the stock. I'm not short the stock. No options. None of this has anything to do with let's go buy the Concert Pharmaceuticals and make money. As of this moment, I am not an investor in the stock. Okay, this is not even my area of the market. I don't really do this. Shares in Concert Pharmaceuticals rose higher in value Monday after the Lexington, Massachusetts-based biotech reported positive results from a late-stage clinical trial testing its most advanced drug, a treatment for the hair loss condition alopecia areata. And this is at Biopharma Dive.
Wait, is alopecia areata just alopecia, or is that like regular alopecia, aka people like me, just bald
I think
people?
it's like Ariana Grande. I don't really know what it is. Put up this chart, Concert Pharmaceuticals 1-year return. So this I think this kept going today.
No, dude, this is a cure for alopecia. There's not a cure for baldness.
What do you mean? We're saying the same thing.
No. Alopecia. No, it's not. Alopecia
is pattern baldness.
No, it's not.
Yes, it is. Yes, it is. Read the article. Read the article. You have to come prepared having read the source material. There are 3 versions of alopecia. There are 3 types. And this one is specifically to cure bald spots.
How big are the spots are we talking? Are we talking like full spots like me?
My guy, listen to
me. I got a full spot.
Listen to me. I'm telling you that, and by the way, they're not the only company working on this. They enrolled 700 adults with moderate to severe alopecia areata. It's one of 2 phase 3 studies testing the drug. They have another study going right now where the results are coming in the 3rd quarter. And they're going to take the combined data early next year, submit both to the FDA for approval. Pfizer and Eli Lilly are both working on late stage trials. What they're doing is they're inhibiting this thing called JAK. So
I'm just telling you, alopecia areata is not baldness. It's a different thing.
Yes, it is. It's just not the only type of baldness.
All right, Google it.
So you know. Listen to me.
No.
Listen to me. Eventually.
Oh, what the hell is your point? No, I'm not taking it.
No, you wouldn't enroll yourself in the trial?
It's too late. No, I'm good.
Maybe it's too late. There's multiple trials going on. Multiple
it's
drug
too
companies.
late for me. I'm
All right,
married.
here's a question. Do you think baldness will be cured before 2030?
2030?
Do you think people will have the ability to take a pharmaceutical and regrow their hair? Or a gene therapy or something?
Yes.
You do? Okay. Now, what are we thinking for you? Cornrows? What are we thinking? Very aggressive
Do you
ponytail?
know I did cornrows in 1990. When was Gangsta's Paradise? 93?
95.
95? Okay, I did that. I was Coolio for Halloween.
My God.
It went very well.
Yeah, no. Hopefully there's no pictures of that anywhere. Listen, I read this and I was excited for you. I think I might just make it.
No, you can do it. You can do it because you still have hair. I'm over the line.
Can I just tell you the results? Participants in the study had, on average, less than 15% scalp coverage at the start of the study. After 24 weeks, 42% of people treated with a high dose of Concert's drug achieved 80% or greater hair coverage compared to just 1% of those given placebo. And there are pictures. The proportion of patients on the lower dose reaching the 80% benchmark was also greater, with 30% meeting that goal.
All right, great.
The only side effect is you can never walk again.
All right, it's worth it.
No, I'm kidding. No, I'm kidding. Anyway, I was very excited. Okay, so you don't seem that excited. I thought.
Wait, is Concert Pharmaceuticals a SPAC?
No, this company's actually been around 6 or 7
years. No, I'm not. Honestly, I love being bald.
Come on, seriously?
Swear to God.
I might get this for you for your 40th birthday. Okay, let's bring in Duncan and we'll wrap up with 2 user topics.
Hey guys,
what are you shaking your head at?
Duncan, you agree with me? Alopecia areata is not baldness. It's a very specific disease.
I have no idea. I have no idea, but I did ask a poll, and 47% of people said that if you can regrow hair one day, you should, Michael.
Me specifically?
Yes. Yeah.
Okay.
So I voted for ponytail.
That's kind of cool.
Yeah, I voted for ponytail.
The side effect, actually, people are making jokes in the chat. It's something called thrombosis is what they're watching the trials for.
This is my look how much hair I used to have.
Oh my God.
I don't know that you should be showing your ID.
Wait, why is that still your license? Is that still your license?
Yeah.
So what do you do when you present that to the TSA?
I say I have alopecia areata.
Wait. Is that what you're going to look like after you take the concert form?
It depends. It depends if it gets past clinicals.
Oh my God.
All right. Proud of you. Yeah.
Okay, so up first tonight, we have a question from Sam, who writes, I tell myself that if a stock I like were to go down by 20% or so, I would use it as an opportunity to buy more shares. However, when the decline of 20% actually happens, I become too pessimistic and fearful to buy more shares. Can you explain this phenomenon?
Yes.
Well, welcome to the stock market.
Yeah. I mean, you think your stock's going to fall 20% just because it falls 20%? No, it falls 20% because there's really shitty news coming out. It's that simple.
Yeah. Drops in stocks or in the overall market are not accompanied by calm. They're accompanied by like scary things coming out, and that's why they drop. It's not everybody just randomly panics. They panic for a reason, and you're going to be aware of that reason too. So
that's it.
Yeah. I wish mine were only down 20, you know. But, okay, so
somebody asked me, am I going to go all the way and shave my head, or am I holding out for the miracle cure? Miracle cure, please. I'll take it. I'm holding out. I'm waiting for it.
No, Josh is in a secular bear market. Will there be some rallies?
My hair is my security blanket. I need it.
Yeah.
This is the rally. All right, go ahead.
Okay. Up next, we have a question from Dave in London. I have a question about U.S. government bonds in the current climate. Given how far they've fallen recently, and that presumably forthcoming rate hikes have already been priced in based on the market's expectations, does this finally present a good moment to buy such bonds? I typically buy mid-duration bonds for a balance of volatility and negative correlation with equities, but given the current environment, are there any benefits to buying shorter or longer duration bonds?
It depends what you're trying to do here. So if the yield curve is pretty flat, which it is right now, that means that you're not being paid to take more duration risk, right? If you're like 3 to 7 and you're getting 2%, I'm making that up, or you're 7 to 10 and you're getting 2.2%, maybe it's not worth it. However, if you believe that interest rates are going to decline and you're not in it for like the long-term coupons and you're in it for some stability on the downside, or maybe like more something like a trade, then even though they have the same coupons or yield to maturities or whatever it is, you can still get paid more by taking a more duration risk.
I called the bottom in the bond market 3 weeks ago. I'm still waiting.
Will you give that up?
I'm still waiting for credit.
What are you talking about, dude? It fucking bounced like an inch.
What do you mean?
What
it was the bottom.
bottom?
It hasn't gone lower since. That's all I'm saying.
It's not
That's
like we
all
got
I'm saying. 10-year bounced more than an inch.
Inch and a half.
10-year was 3.25.
Dude, that's not. You're not Paul Tudor Jones. That was like it barely bounced. It bounced a tiny bit.
I call that like Babe Ruth pointing to the outfield. You want to do something gangster?
Outfield.
You want to do something?
Barely bounced. You don't get to call. You don't have to pat yourself on the back.
All right, we're running out of time here. You want to do something gangster? Look at like if you really think that there's an opportunity now because we've seen the worst and the market is already priced in.
Did you buy zero coupon bonds? I don't care what you called. Did you buy zero coupon bonds?
No, but I bought a bunch of short-term treasuries and short-term muni bonds via ETF. I should have bought mid-duration.
Congrats, you're up 11 basis points.
I didn't have the guts. All right, look at the mortgage REITs. Look at the mortgage REITs. They are mostly selling, the publicly traded ones selling at book value. Book value has crashed because of the spread between treasuries and mortgage rates. These companies are pretty savvy about hedging out interest rate risk. They don't take credit risk because they're buying Fannie and Freddie paper for the most part, which is backed by the U.S. government. The biggest, most well-known one is in a massive bear market right now. Annaly.
Which one, Annaly?
NLY. Looks awful. There's another one, Agency, AGNC. This is a slightly smaller version of Annaly.
Yeah,
also based out of New York.
Why are we talking about mortgage REITs? What's going on?
We're saying like
it's
if you want
6:30 on a Tuesday.
If you want to do something gangster as a rates trade and you want to go the other way thinking that the news is already in, do that. Don't do like mid-grade treasuries. You're not going to get any bang for your buck if you're right. Okay, that's all I want to say on that. We're going to wrap up here. Thank you, Duncan. Thank you, John. Thanks, Nicole. Sean on the research side. Thank you, Benny Markets. You guys were great tonight. Really, really funny stuff in the chat. I'm going to be reviewing it later. Thank you for coming by for the live. Don't forget, tomorrow's Wednesday. Brand new Animal Spirits. As soon as you wake up, check your favorite podcast app for new Mike and Ben. Like and subscribe. Like and subscribe. We'll see you guys next week.